What do you think is most pressing for investors here? Is it tapering from the ECB or some change to policy, or is it the Fed?
Well, I think it's the Fed, and I think the Fed are going to raise rates in December. I mean, the market's telling you that through the odds. I think the question is, where do they go from there, and what is the terminal rate, if you like, in this next cycle? And we think it's going to be a lot lower than past cycles. So if you move to a 2.5% 10-year yield, that's going to be quite a big event if you're a bondholder, and it's going to have a bit of equity volatility alongside it, because as bonds have gone down in price, so have equities a bit recently. There's been a positive correlation in direction between them. So I think it really comes down to where the Fed goes, and why we think that there's going to be this lower terminal rate is simply there's a lower terminal growth rate for the US economy, demographics, debt overhang, all of the above. And we think that the rate cycle is going to be a gentle one rather than a particularly sharp one. And once investors get past the problem of worrying too much about the price and focus on the quantity of monetary policy, which is the thing that's really inflating asset prices now, then I think we'll see a bit more sorting out.
If the destination for US interest rates is much lower than in the past, what does this mean for the reflation trade that's been happening right across markets? Has it gone too far or not?
Well,
enough?
reflation trade has come from a very low base, Karen, and I think that here is where the shape of the yield curve matters a little bit, and of course that's what the ECB is sort of talking about behind their hands. Now that's what the Bank of Japan are talking about, and that's, although they're not saying it out loud, that's what the Fed are talking about as well. And a slightly steeper yield curve, albeit a very low nominal one, of course supports the reflation trade. And actually, economies are not doing too badly as long as you understand that the real trend growth of the United States economy is maybe 2 to 3 rather than 3 to 4. It's a long, extended, slow business cycle.
Our guest host yesterday, Bob Janjuja, said that actually get this Fed rate hike out the way, and actually the probability of the Fed hiking more is equally likely as the Fed having to cut rates or add further stimulus. Do you buy that argument?
I think there's a little bit further to go. I mean, I understand what he's saying because there is a very significant rate sensitivity. But that also relates to how much the difference between the front end, the short-dated bills and long-dated bonds, how much steepening comes into place in the United States, because of course most credit in the United States is priced off long-duration government bonds.
So why would this time be different? Because the last time they hiked rates, we saw a fourfold multiplier effect in the tightening that we saw across asset prices and markets.
Well, I think the market expects a Fed rate cycle. I think it's been.
It did last time.
Yeah, but I think this is pretty well sort of laid out now. It's a question now. The debate is on 2 points: how gentle is that rate cycle, and also, critically, are they going to sustain the size of the balance sheet? And the answer on the second one appears to be unequivocally yes. If you start to shrink the balance sheet, then that is real monetary tightening.